Welcome along to Trader Talk Radio, the original show for today. Today, the 23rd of May 2021. My name is Paul Botch. I'm the founder of Actions to Wealth, and it is my great pleasure to have you along with us today. I'll be joined by the team as they come in today. We've got Julian, Alexis, Ainslie, McCree, all due to come and share a little bit about their view on the markets today, joined by Geoff as well, as my understanding. Normally at this stage we would have Julian in, but he may be having an extended break. He's just finished his 2-hour macro overview. If you guys had a chance to have a look at the macro overview and you've got some feedback for us and you're in this session, I'd appreciate if you could punch that into a group. I can just see Julian signing as we speak. So we'll go to Julian in a couple of minutes and then on to Alexis. As I said, if you've got any feedback on the earlier session with Julian, I'd appreciate if you can put it in the chat. It's always good to see what you guys think of the stuff that we do and what you guys are learning from it. It's obviously all about that. Julian, how are you, mate?
Hey, Paul, a little hoarse.
Mate, I'm not surprised. How was it, mate? I'm afraid my kids didn't go to sleep very well tonight. I've been away. I only got sort of back and I didn't really want to go to sleep. So how was it?
Well, I enjoyed it. I hope everybody else did too. So it's always nice for me to have a quick scoop around the markets and also cover some fundamental aspects of trading as well too. So we sort of we had a good macro overview. For those of you that didn't manage to take part in it, then I think you missed a good session, and maybe there's a recording that you can catch up on later. But yeah, look, I'm really happy to maybe summarize a little bit about what I was saying at the end of the conversation. I think I'll try and make it super quick because I've only got a few minutes, and we're not going to show many charts this time. What I'm going to do is I'll just share a few slides with you. Well, not even a few slides. I'm just going to start with just one or two slides, I think, around what's going on. So let me just get straight into this. Could you just allow me to have the screen, Paul?
Mai, can you do that? I think Mai is the host of this one, and she has to give us all the powers. Mai, can you give us all the powers, please? There you go. I think your co-host now, Julian, should be able to share screen.
Great. Okay, folks, that's it. So yeah, right. Let's get straight into this, and hopefully, come on, clicking buttons, and I'll click through all of this stuff. Apologies for this. This is there we go. That's what I talked about. So I hope that's pretty clear to everybody. Let's go with the end slide, and I'll start there. Hopefully, you guys can see that. Let's just run with that one. I think, which is probably easiest. So look, hopefully you can, maybe if I just press share, that will probably help.
Can make a difference.
Okay, hopefully everybody can see that last slide that I've got up there. So look, my basic contention here is that I'm not entirely sure that inflation is going to be anything other than transitory. The reason why I say that is a number of reasons. The three key areas that we have to think about are the pandemic, fiscal spending, and also the supply chain bottlenecks that we're seeing pretty much in every part of the world. So when I think about each of those, I believe that fiscal spending is probably topping out a bit quicker than people think at the moment. I don't think the Biden government can continue to issue checks to people who don't necessarily need it. We know only 1/3 of those checks are actually being used for consumption. The rest are either being plonked into to pay down debt or else to put into the stock market. If that does come to an end, then obviously there'll be a big liquidity wave, which won't be going into stocks, and that's got to have an implication, because at some point, markets don't go down because there's suddenly a whole heap of extra sellers. They actually go down sometimes because there's a lack of buyers. And my worry here is that there's going to be a lack of buyers in that US stock market. The timing cycles look right. And for those of you that have been following Gordon, he's obviously been banging the table about this. And I have a lot of time for the timing cycles. So we could see some rough weather for the next few weeks and months in the stock market. There will be a time to buy, but I'm just not sure it's going to be for a little bit of time. How does that affect other markets? Well, given that over 90% of people believe bonds are going to be over 10-year bond yields in the US are going to be over 2% by the end of the year, that's a pretty bearish lot. I would imagine that most of those people are either not invested in bonds or they have short positions in bonds. Well, in the world of who is left therefore to sell them, it wouldn't take a reach to say that there's actually nobody really left to sell them, maybe apart from the Treasury. So what may happen here is that we could easily see those bond yields either stabilizing or falling, simply because everybody is on one side of the boat, and they're on the wrong side of the boat. So traditionally, inflation tends to subside in the second half of the year. That would coincide, very interestingly, with a rally in bonds, and especially if you look at the 30-year bond, there's a duration asset play there that could make you about 20% if you held it over the course of the next 6 to 9 months. And inflation did indeed subside, and bond yields fell back towards the 1.25%, 1.20% for the 10-year, and possibly the 1.70, 1.60 for the 30-year bond. By the way, for the record, often tech stocks are long duration assets as well too. For those of you that don't know what that means, please go look up duration in financial assets on Google. I haven't quite got time to explain it, but tech stocks are often seen as a long duration asset, and I would imagine they will outperform, you heard it here first, outperform value stocks in the course of the next 6 months. So there's an asset class there that I think is quite interesting, but it's only going to happen, right, if the spending slows down, if the supply chain situations are seen as being transitory and resolve themselves. When you look at the exports from Taiwan and from South Korea over the course of the last 3 months, that transitory nature probably isn't a bad discussion, because their exports have simply gone off the charts upwards. They burst out the top of everybody's charts. Okay, so they are exporting as much as they can. There's a reason why all those ships are waiting outside of Long Beach. It used to be because everybody had COVID and there was nobody to unload it. Now it's just a wave of product that's trying to reach American shores. It wouldn't be a reach to say that as that wave of product hits there, prices will stabilize in some of those commodity markets. So, you've got to judge this with the fact that overall equity valuations look high, and if inflation starts to come down, do they look high then? Well, with negative 4% or 4% negative real yields, then it's really hard to sell equities. At -3 or -2, is it still really hard to sell equities? I believe so. So is there really a bear case for equities here? Probably not. But equally, there's nothing wrong with them falling back to 10 to 20%, and in a corrective phase that would be quite normal, quite reasonable. They are pretty expensive right now and washes a few people out who are weak holders. That, by the way, is not a bear market. And it's not unreasonable to see that happening, but that's a long way. That's like losing 400 points in the S&P, which right now would appear to give it a heart attack. So bear that in mind. Hey, look, volatility is way too low in FX, I think, for some of the disruptions that are going on. I think the European market is in a different place to the US, which is certainly a different place to Asia. There's no other way of putting that. And I think that's going to be reflected in volatility in the FX markets. You could argue that the Aussie dollar is too cheap. You could argue actually it's too expensive. So there's arguments for both cases. Probably the reason why it's gone sideways for 3 months and continuing to go sideways. I believe there's a bear case coming on for the Aussie at the moment. Maybe the US dollar strengthens a little bit over the course of the next few weeks. That's my sort of play at the moment on a micro level from a trading perspective. You've seen that in my broadcast group. We'll see how that plays out. But a lot of that is, honestly, come on, Canadian dollar's gone from 140 something down to 120 in a straight line for the last 6 to 9 months, pretty much tracking the commodity market. Nobody in their right mind would be long of Canadian dollars right now. So everybody is short of it. There is one side of the boat that is absolutely overpopulated. Will this be the low? I'd love it to be, because then my trade would work, but I suspect I might have to have a couple of bites at the cherry, so we'll see how we get on with that. And but the low is probably coming at some point in time, sooner or later, in the next month or so, who knows. But that really depends on what happens to those commodity markets, and I've left them till last mainly because, let me show you one chart that I think makes a bit of sense to me. Let me just see where I've got it. Where is my commodity chart that I need to show you guys, because it's hopefully a little interesting. Oh no, I can't find it. There's nothing worse than, here we go. This is the speculative long positions in some of the commodities. Now listen, sometimes their speculative long positions are out there and all the time. Please ignore the one in coffee, because that is giving me a painful headache right now, because I'm long of coffee and therefore in the fragile position of being the most over-owned speculative long position in the market right now, which is entertaining. But you can see, you get the gist, right? You look at this, pretty much everybody's got this stuff. And as I was saying in my talk right now, a lot of these are trading well above, I mean, like a long way above marginal cost, right? What it costs to make this stuff. They have been driven up by financial positioning. Equally, they can be driven down by financial deleveraging. So what will cause that to happen is the inflation argument going away. So just be on your game that that's a risk, right? I'm not saying it's going to happen. I'm just saying it's a risk. So there really is my scoot around the world. The other thing I guess I ought to mention, because crypto is pretty important, the only thing I will say about it is I still have no idea where it's going. There's some value in Bitcoin in the low 30s and high 20s, I think, just for a trading position. Same in Ethereum around the 1800 to 2200 mark. That sort of makes sense as a bounce point before we have a rally. I don't think that's a surprise to anybody. It's about the halfway point pretty much for most of those markets, or a 618 retracement in the case of Bitcoin. But what really is important to me is volatility there is too high. It's really hard to build a bull market off a 10% to in one case, I think one day last week we had a 25% move in that market. Come on, you can't build positions in any type of commodity or market or equity with a 25% move in a day. That's just completely nuts. It can't be true, can't happen, and therefore we need that volatility to unwind, and then people will build a more longer term enduring position in the cryptocurrencies. Paul, that's it for me. Thank you very much, everybody, for listening.
Cheers, Julian. Enjoy a well overdue rest. Thank you very much for your couple of hours today and for coming back and doing another summary for us tonight, mate. It's much appreciated. Always fascinating stuff. So enjoy a break, mate. Thank you very much.